Welcome to lesson 2. This is Accurate Pips YouTube channel, and it is Accurate Pips 2025 mentorship program. And I'm glad that you are all partaking in this particular mentorship. So, yesterday we looked at lesson 1, but today we are going to be looking at lesson 2. And lesson 2, we'll be looking at the terminologies that we are going to be using in throughout the lesson. Okay, so I divide lesson 2 into two parts. Okay, so we have lesson 2.1 and then we have lesson 2.2. All right, so 2.1 will be the basic terminologies, and 2.2 will be the advanced terminologies. Okay, now the reason why I break it down into two is there are terms that one generally we use them throughout, but the other terms we will be using them specifically under SMC or what we call smart money concept or institutional trading. Okay, so they are the ones that will be under the advanced, but then with the basic is the general terms, whether you are doing advanced or any of the strategies you are doing, those terms are there. You use them, they are general. Okay, so we will be looking in this particular lesson, we will be looking at lesson 2.1, all right, which is the basic terminologies. All right, we will look at the basic terminologies, and the first terminology we'll be looking at is the currency pair. Currency pair. All right. Now, the reason why it is important to know what a currency pair is because you'll be using it, you'll be using that term a lot uh, as we go along. Okay, I spoke briefly about some of those pairs yesterday when we were looking at the major, the minor, and the exotic pairs. So, what is a currency pair? When we talk about a currency pair, we are talking about the combination of what? Two different currencies from two different countries. Okay, put together to be traded as one. Okay, so that's why we call it a pair. Okay, so when we take the currency pair, we are looking at two different currencies. So, for instance, let's say we are looking at the euro and the dollar, the United States dollar. Okay, so when we put these two together, called we get a pair called euro USD. Okay, we get a pair called what? Euro USD. Now, the the um the thing about currency pair is that one is what we call the base pair, and the other is the quote pair. Now, why do we call this? Because whilst we are buying one pair, we are selling the other one. It means we are using this one to buy the other one. All right. So in this pair, in this Euro USD pair here, the first pair, which is the euro, is referred to as the base currency, C for currency. And the second pair, which is the United States dollar, is referred to as the quote currency. All right. Now, when we take Euro USD, when we press the buy button, it means we are buying the euros using the dollar. So when we are using the dollar to buy the euros, it means at that time we are selling the dollar for the euros. Okay, so The second currency is the code currency, and the first currency is the odd is the base currency. So the base currency is what we buy, the um uh code currency is what we sell. So when you press the sell button, you are selling the odd, the dollar. um you are buying the dollar, selling the euro. Okay, so it will be like opposite. When you press the buy button, you are buying the euro and selling the dollar. That is why this becomes the base and this is the code currency. Now, we have other pairs like the USD, USD, JPY. In this case, the USD becomes the what? The base currency, BC. And the JPY becomes the code currency, QC. Alright. So any pair that you take, whether USD, whichever pair that it is that you take, always the first is the base currency and the second is the code currency. Alright. I hope we are following. So that is the first terminology that you need to understand, or you need to what? You need to get. Okay. You need to understand that um when you take those two pairs, the first one is the base. That is the important thing, and that is the buying. If you are buying, that the first which is the base currency is what you are buying, and the code currency is what you are selling. Now let's look at the next terminology, which is the lot. Or also we can sometimes say the lot size. It's just the same thing. Okay. But you'll be hearing more often the lot size a lot, more than just the word lot. So let me just use that. Okay, so let's go on. So now, if we take lot size, what are we referring to? Okay. So the lot size actually is the how I say it, we use it to determine the standard quantity of any currency that we are buying. For instance, when we take euro and USD, the quantity of euro we are buying is determined by the what? The lot size. So lot size in forex refers to what? The standardized quantity of a currency that you trade. We use it to determine how much we are buying or we are selling. Okay, so if we are selling USD, it will what? It will tell us the of quantity of the USD we are what? We are selling. And then it will also tell us the quantity, Q for quantity of the euro we are what? We are buying. Okay, so that is a lot size. Now let's look at the different types of lot sizes that we have. We have four main types of what? Lot size. We have the first one is what? The standard lot. The standard lot. Okay. Then the second one is the mini lot. The mini lot. Then we have the micro lot, and we have the nano lot. All right. So now let me explain each of these. When we take the standard lot, it means we are looking at 1,000 units, 100,000 units, 100,000 units of that particular currency that we are buying, and this is represented by one standard lot, one lot. When we take a mini lot, then we are saying that we are buying 10,000 units of the currency, and that is represented by what? A 0.10 lot. When we take a micro lot, we are saying that we are buying 1,000 units of the of the currency, which we represent in terms of lot size by 0.01 lot. Then when we say nano lot, we are referring to 100 units of the currency, which is represented by a 0.001 lot. Okay, most brokers end their lot size on the micro lot. You hardly see brokers with a nano lot. Okay, mostly it is from the micro lot to the standard lot. All right, and then it goes on. We can have 10 lots, we can have 100 lots size. Okay, depending on your account size, we'll come to those things. So that those are the types of lot sizes that we have. For instance, let me just set a quick example for you. Let's say we are buying, okay, let's say we are buying one standard lot of euro USD, okay, of euro USD. What we are saying is that we are buying 100,000 units of euros. Okay, that is all we are saying. Now we are buying what? 100,000 units of what? Euros. And the lot size that you use is what? Is 1. Okay, so anytime you open a trade of one lot, it means you are on, let's say, euro USD. It means you are buying what? 1,000 units of it. Is that clear? Now, if you open a position of 0.1, it means you are bought 10,000 units of 10,000 units of euro. All right. So that is basically what it means, and that is basically what lot size does. Now, what is the importance of lot size in trading? Why is lot sizes important in in trading? Now, when you take your account, the bigger your lot, okay, the higher your gain. The same way, the higher your risk. Sorry, I don't know why my writing tool is not responding fast. Okay, so the bigger lot size you use, the higher your gain, and the same way, it means the higher your risk. Therefore, the higher you lose as well. So higher gain, higher risk. All right. So it is important that you always choose the right lot for your account. is what? Is always good to what? To choose the right what? Lot for what? Your account. Keep that in mind, guys. Okay. All right. So let's go on to the next terminology. Let me clean the board. All right. Let's go on to the next terminology. That is PIP. Okay. The next thing we'll look at is what? Is PIPs or PIP. All right. Now, when we take PIP, we are looking. So PIP is like when we say distance in physics or mathematics. Okay. Distance is measured in what? Distance is measured in either centimeters or what? Meters. Okay. Now, when we come to Forex, the movement of price is also measured, and the unit for that measurement is what we call a pip. All right. The smallest price movement of any currency pair is what we call what? A pip. Now, when we want to find a pip for the standard for the normal pairs, aside the JPY pairs, all the other pairs, when we want to find their what? Their pip, we use the what? The fourth decimal point. The fourth what? Decimal place. So let's say we have 0.0001. We will use the fourth placed decimal point in doing our pip calculation. Okay, so that is something you should what? You should put in mind. It is something you should put in mind. But for the JPY pairs, okay, we use the what? The second decimal place. Now, for some brokers, you will see about five. If you are using a broker that has a fifth decimal place, please, when you are calculating, ignore this. We call it the pipette, the smallest of the pip. Okay, so we don't use the fifth place, we use the fourth. All right. Then with the JPY, if it is 3, ignore the third decimal point and use the what? The second decimal place. The second decimal place. Guys, I hope you are following. All right. Now, let's have a look at the way. Let me just quickly explain how we can calculate the pips. Okay, let me explain quickly. Now, if you take, let's say, USD JPY, and let's say price moves from let me use a figure 145.60, okay, to let's say 1 4 sorry to 145.7 yeah, okay, so 70. To calculate the pips for this movement, okay, you subtract 1456 from 1457. Okay, so the two decimal points is what we are going to use. So you subtract 0.70 minus 0.60. Okay, that is the second places. That is what we use. But in this scenario, you can notice that the second places are all zero, and from our normal or usual mathematics, they will say you go and borrow one from here and bring it here. You understand? So we will borrow 1 from here, bring it here, making it what? 10. You get it. When you deduct 0 from 10, what do you get? You get what? 10. So the movement is what? Is 10 pips. Okay, so the movement from this place to this place is what? Is 10 pips. So this is how we measure the movement in the market. Now let me do one with the Euro USD. So let's say Euro USD moved from, let's say, 1.10502 1.1055. Now I said we will use what? The fifth decimal place. In this case, we have our what? Our fifth decimal as what? As a whole number. So we are going to what? We are going to subtract this one. The fifth one is 0. This is what? 5. We are going to subtract 0 from what? 5, and that is going to give us what? 5 pips. Okay, so the movement from here to here on Euro USD is what? Is 5 pips. So that is how you calculate. But now the platforms have given you the tools to help you determine all these things. So as we move on, you shouldn't find it difficult to what? To determine. So the pips helps you to what? As a trader, to measure your what? Your profit or your loss. Okay, your P&L. Pips help you to determine them. Okay, depending on what? Your lot size, as we previously discussed. Okay, all right. Now let's look at the next terminology, that is the spread. Okay, let's look at the spread. Very, very important. The next one is what? Spread. Okay, spread. Now, what is the spread? When we take the spread, spread is simply the difference between the what? The ask price, the ask price, the ask price and the bid price. So ask price minus bid price will give you what? Your spread. Okay. Now, the spread is the cost that you are charged for opening trade, and it is also calculated in what? In pips. Okay, it is what? Calculated in pips. Now, when we say spread, this is the charge that the broker charges you for using their platform, or for them serving as a middleman between you and the central market or the global central market. Okay, since you as a trader, a retail trader, cannot get access directly to what? To the global market. All right. Now, what that brings us to the next this thing. What is what? Bid price. Quickly. Now, when we say bid price, that is the what? The price traders sell at. So is the selling price. Why is this thing slow today like this? Okay, so the bid price is the selling price. Then the ask price is the price at which we buy. Okay, so that is the buying price. So ask price is the buying price and the bid price is the selling price. Okay, the difference between the two is what we refer to as the spread. So take notice of that. So if, let's say, for instance, the bid price is, let's say 1.1050, and the ask price is, let's say, 1.1052. It means the charge the broker is going to take from you, which is the spread, is what? Is point 0.2. Okay, 0 point what? Sorry, is 2 pips. 2 pips. Sorry, is what? 2 pips. So it means the the broker is charging you 2 pips to buy, in order for you to buy what? Euro USD. To buy euro what? USD. So please keep that in mind. Okay. I think my network is slow. It's slowing down. Uh, it's slowing down my writing for the board I'm using. So guys, bear with me today, please. This thing load fast. Okay, so I hope you guys understand so far, up to where we've gotten to so far. I hope you guys have understood everything very well. Okay. Um, um, Let me see if there's something. Okay, so before we go to the next listing, we have two types of spreads. Okay, we have two type of spread. We have um fixed, the fixed one, the fixed spread, and then we have the what? The variable. We have the variable spread. The fixed spread, it simply means it is constant, it doesn't change. And then the variable, it means what? It changes. So, and mostly the variable mostly changes very wide during news events, a lot. Okay, during news events. Then why are spread important? Now, when you have low spread, okay, it means that your trading cost is what? Is low. And if the spread is high, it means your trading cost is what? Is high. And mostly those uh, high spreads occur when volatility is high. When we have what? High volatility. When we have high volatility. Okay. All right. Now let's move to the next thing. I want to talk about current price. We've talked about spread, we've talked about how do we call it? The ask price and the bid price. Now let's look at what? The current price. Okay, so what is current price? P for price. Okay. Now, when we talk about the current price in forex trading, it is the last traded price of a currency pair. Okay, the last price that the currency pair is traded at. All right. If let's say um uh okay, so let's say if your last transaction, for instance, is a sell, it means your last or your current trading price is your what? Is your bid price. Okay, if it is buy, if it is a buy, it means your current trading price is your what? Is your ask price. Your ask price. Okay, because that is the uh, point at which you are doing your last transaction. So that is the current price or the current traded price. Okay. Okay. Now, one thing you have to know. Okay. This term will be used a lot. Current market price. Somebody will say, if for instance they are giving signals, the person will say, oh, enter the market at the current price. You see, so that is why it is important to know what current price is. Anytime I see this, so anybody put CMP, it means they say current market price, which is the same as the current price. Okay, so put it in mind that that is what they are talking about. All right. Okay, so another thing to you need to understand is that the current price um, changes because we have something in the market we call supply and demand. Okay, supply and demand is just something that we'll be talking about later as we move on. Okay, so when there is selling pressure, then we are looking at what? Supply. If there is high selling volume, we are looking at supply. If there is high buying volume, then we are looking at what? At demand. Okay. So we will be looking at that market, and market price determines this, or the current price also constantly change due to supply and what and demand. So it can move from high from low to high, and can move from high to low due to what? Supply and what? Demand. Okay, now let's look at what a take profit order is. Take profit, you hear traders talk a lot about take profit, or you hear the word TP. So what is a take profit order? Now this is a preset price, so it means we set it before market gets there. So it is a preset price level at which trade will automatically close in order to secure you the backs, okay, profit. So that is simply what a take profit order. So if you are what? If you are buying, if you buy, your take profit is above the what? The buying price, the price at which you what? You bought. And if you are selling, um the take profit is below the what? The entry price. Okay, a take profit is below the entry price when we are what? When we are selling, and it is above if we are what? If we are buying. Okay. All right. Now let's look at what we call this. But first, why is it important that you put take profit? It is important for you to put take profit so that you can always lock profit. You can always lock profit. Okay, you always lock in profit. Even if you are not with your machine, you are not with your phone, your profit will still be what? Be locked in for you to come and enjoy. Okay, so yeah, that is the reason why we do what? We use take profit. Then we look at another important one. Use take profit to also prevent yourself from greediness, because sometimes you'll be in a huge profit, and then some of you, oh, you should go again, before you know, market reverses on you. So yeah, it's also important to prevent greed. Okay, greed, greed, greed in trading is very, very bad. All right. So the next thing is the sorry is the stop loss order. Okay, so just like the take profit order, the stop loss order also is a preset order that prevents price from what? Um, that prevents you from incurring further loss. Okay, so for instance, if you said price should automatically close once you lose, let's say $5, you set your stop loss at the point that gives you the $5. So immediately your loss gets to what? To that point, the trade closes automatically. All right. So if we are buying, the stop loss is always below the entry. And if we are what? If we are selling, the stop loss is above what? The entry. Okay. Why is it important for you to what? To put stop loss? It is important for you to put stop loss in order to prevent large losses. Okay. Large losses. So you don't lose too much. All right. Then also, it is also important to control what? Risk. It helps you to control risk. You know, okay, I'm risking maybe 1%. Sorry. Maybe I'm risking 1%, I'm risking 2%, I'm risking 3%. Okay, so mostly risk between, if you don't have money, risk between 1% to about 3% maximum. But if you have money and you want to risk everything, fine, you can risk everything, because if you risk everything and you are making profit too, yeah, you make crazy profit. So no risk, no gain. All right. But then I always teach people proper uh, money management. But then also I always want to say that if you are a risk taker, you have the money to risk it, because if you are making it, you're also making it big time. It's as simple as that. So that leaves us talking about risk. We are then going to look at what we call leverage, because leverage trading is what the risk traders like a lot. Okay, because leverage is like a borrowed money that the broker is giving you. Okay, so that your $10 can look as though you are trading a $10,000 account if they've given you a leverage that is, let's say, 1:1,000. It means you are multiplying the 1,000 by what? The $10. Okay, so you just add 10, it becomes what? 10,000. So in what? When you imagine your $10 using a leverage of what? 1:1,000, it means you are looking at it as though you are handling a $10,000 account. Now, what this does is it gives you the ability, okay, it gives you the ability to trade like somebody who is having what? A $10,000 account. Mind you, if you are trading like somebody who is having a $10,000 account with your what? $10 money, what happens is that you are risking the same as well, like somebody who is having what? A $10,000 account. So a little movement in loss, your money is what? Gone. Your money is what? Gone. So leverage is a two-edged sword. It can either make you or unmake you. So yeah, you hear people say, I'm going full margin. Okay, full margin. When you are trading full margin, that means you are making proper use of your leverage. You are taking advantage of the leverage the broker has given you. All right. Then we say you are what? You are making you are trading full margin. So leverage in forex trading allows traders to control a large position with a smaller amount of money. It is expressed in what? In a ratio form. So we can have a 1:10, a 1:1. So 1:1 means if you have $10, you only be trading $10. A 1:50, 1:20, 1 is to just a minute, please. 1:100. I'm coming. Let me. Okay. 1 is to what? Is to 100. 1:1,000, and so on and so forth. Okay. So we have all these ratios over there. Okay. So some brokers also give what we call uh, One is to unlimited, but I beg you don't go and use those kind of guys. They can be very, very, oh, come on. One is to what? Unlimited leverage. Those guys can mess you up sometime. Okay. Now, one good thing about leverage is if you are somebody whose analysis gives you a small risk distance, it means you can use a bigger lot. Okay. Yeah. So you can use maybe let's say 10 lot on even a $10 account, and even if you lose, you are not losing much, because your risk margin is what? Is small, but then your profit margin is large. So when you are winning, you are winning huge. So it's just a tip of I'm giving you guys. You can use it to uh, do whatever you want to do when you master how to trade. Okay. All right. So yeah, the thing is, once you have leverage, you have the increasing trading power with more capital. But then also remember that what? It has a high risk which can wipe out your account if not properly what? Managed. Let me tell you that before I go to the next thing. So the next thing I want to look at what? The buyers and the sellers. So the buyers are are known as what? The bulls in the market. The bulls. The sellers are the bears in the market. Okay, so these are the two participants of the market, as I told you yesterday during the class. Okay, now the buyers, when they want to buy, they perform a function we call long. So when you hear somebody say, I am longing Euro USD, it means the person said, I'm buying Euro USD. So I'm not going to define that term again, I've defined it. And then the bears does something we call shorting. Okay, so when you hear somebody say, I'm shorting a position, the person is telling you that I am opening a sell trade. So these are the two terminologies that we use. Either you hear buy or you hear long, sell or short. Okay, right. So yeah, these are the terms that the bulls and the bears sort use a lot to tell you whether they are buying or selling in the market. Okay, so both buyers, the importance of both buyers and sellers in the market is that they help market to what? To move, because they are creating supply and demand in the system, causing market to go up, down, up, down, up, down. Okay, so yeah, that is their activity in the market. Okay, then the next thing I want to look at quickly is market trends. Market trends. Okay, so when we talk about market trends, we are talking about direction of the market. Okay, what is the direction of the market? Market trends. So as I said, market trends, we are looking at our direction of what? Of the market, or that particular what? Where you are trading. So we have three major market movements. Okay, we have three major market movements. We have the downtrend, also known as the bearish market or the bearish trend. We have the uptrend, also known as the bullish market or the bullish trend. Okay, or the upward trend or the downward trend for downtrend. Okay, then we have the sideways, the sideways. Okay, so when we talk about the sideways, we also refer to it as the range market or the ranging market. And it is also sometimes called consolidation. Consolidation. Okay, all of them is referring to what? The same thing. Okay, whether consolidation, sideways market, ranging market, we are simply talking about the same thing. Okay, at the end of the day, we are talking about what? The same thing. All right, now I think we are almost done with the first part, but before I talk about the last thing, let's look at why it is important for you to know the market trend. Okay, most of these things it means in the future lessons I will not repeat them. So the importance of market trends is for you to make informed decisions. Okay, whether so if you know that the market is trending upward, then it means that in all your decision making you only be thinking about what? Buys, only buying. And if the market is down in your decision making, you only be thinking about what? Sells. Now, if the market is ranging between 2 points, then your decision making will be to what? To be patient for the market to give you what? A proper direction. Okay, you remain patient for the market to what? To give you a proper direction. Okay, that is the importance of what? Of the trends. Another importance of it is for you to what? Reduce your risk and increase your profit potential. Because for instance, let's say market is going down and you are just buying recklessly, you will lose money. Or if market is going up and you are just selling recklessly, you lose money. Now if market is going sideways and you are buying or selling, sometimes you can be what? Frustrated. So you have to always have a proper and clear direction of where market is going. All right. So yeah, that is for market trends. Okay. Then I think the last thing I want to talk about so that we end today's yeah, I think let me talk about this before we end. Is the last one is support and resistance. Okay, support and resistance. I'll talk about supply and demand um under the next one. So let me talk about support and resistance together. Okay, because the two of them work hand in hand. Resistance. Now, when we talk about support, okay, it's like the floor that we step on. Let me use that to what? To make it easy to understand. And when we talk about resistance, it's like our ceiling in our various rooms. Okay, so that you cannot jump and cross that ceiling. If you jump, the ceiling will prevent you from flying upward and then you will fall back. Same way, you cannot just fall into the ground when you walk on the floor. Why? Because the floor is serving as a supporting system that is holding you from what? Going down deep into the earth. So that is how support and resistance work. So support prevents, so for instance, let's say market is moving downwards. When it gets to support, support will prevent market for further going down, all right, and causing market to then reverse upwards And now when price is moving upwards and it meets the resistance, resistance will also prevent it from going further up, and then market will now begin changing direction and then moving back down. So when this is happening between the resistance point and the support, we refer to it as the ranging market until one of them becomes weak and gives way for price to move upward or downward. So if price, let's say if price is to break, okay, upward and continue going up, then it means that we have started the uptrend and we now be looking for only buying positions. Now if it is the other way around and price then decides to what, to come down like this, break the support and continues down, then we will now be looking for only sell opportunities beneath this. Okay, we will come deeper into it because there are times you can buy, you can sell from here down here and you can buy from here to the top. All right, so there are dynamics to this that we can deal with. Okay, so we can buy at all these points. These are things we will look at further in as we move on. All right, so guys, this brings us to the end of today's lesson. We will look at the part 2 tomorrow. I think the part 2 will not be as long as this one is. So take your time and go through all this lesson. Have a nice evening, everybody.